Hey, welcome everyone. It is Jake Pimentel, co-founder and CEO of Tennis Finance, and it is Fridays in FinTech. And we have an excellent guest. We have Alex Johnson joining us all the way from Montana. Excited to have him on. Great to have you here.
Thanks for having me. I'm thrilled to be here.
Awesome. So a quick little intro about Alex. He is a luminary in the fintech sector. He is the founder of Fintech Takes, which is a great newsletter, also part of Workweek. He spent his career over started out with Zoot and then went to FICO as well, also an advisor and investor to many other startups. And really, he has a very unique insight into what's happening in fintech, creates amazing takes, and I've talked to some of his readers and they love some of his contributions and some of the articles he's writing. But really, really great to have you here, Alex.
Well, thank you. I appreciate the invitation. Always fun to talk fintech. It's what I do for a living, so.
Yeah. Cool. So really, we always try to ask the hard-hitting questions starting out. Do you prefer pineapple on your pizza?
Ooh, that is a good question. Yeah, I love pineapple on my pizza. And I think it's weird, honestly, when people don't. And people have like super strong feelings about no pineapple on pizza, but I could not be a bigger fan myself.
I agree. I think it's you should be at least open to trying it, and the perfect balance of sweet and salty.
That's
cool.
what I say. Yeah, no, couldn't agree more. I could go on about that, but I'll let you keep going.
Yeah, we've caught up before, and I really loved your story. Back in the early 2000s when you got into fintech. But I was curious. I wanted to double down on what really drew you into fintech, and what was your experience working at that first company. Just love to hear it.
Yeah, absolutely. I started in fintech, as lots of people like to say, before fintech was a thing. In my case, growing up in Bozeman, Montana, I didn't have a lot of other options. There were two tech companies in town when I was a kid, so not exactly a cradle of sort of Silicon Valley type technology and entrepreneurship. There were two, and I just so happened to get an internship at one of the two, had no idea really anything about financial services. I was 16, so I really didn't know anything about anything, honestly, and ended up working at a company that, as you mentioned, Zoot Enterprises, that provides sort of cloud-based credit decisioning and fraud decisioning, so fintech infrastructure, but again, very, very early, and just sort of cut my teeth there, learned how to write about the space. Among other things, I started the company's blog, and so kind of got invested very early in writing about financial technology, and through that writing trying to figure out sort of what I thought about the space and forming different hypotheses about the space. So that's where I got my start, and I spent a lot of years writing content that, quite frankly, I'm glad it's been erased from the internet and you can't find it anymore, but it was good practice for me.
Those are probably golden nuggets, looking back on that and seeing it like, oh yeah, that's what I thought and that's how I thought. And maybe you were right about a lot of different things.
It's funny. I remember part of the thing when you're first doing content creation very, very early on is you sort of have to zig when everyone else is zagging. And so I remember one of my first zags was when everyone was starting to talk about, like, maybe branch banking is dying. Maybe this digital thing is, going to replace branches. And my zag was, no, that's really stupid. Branches will be around forever. And not that branches have disappeared, but I think I got that first call incorrect. So, again, I'm glad that a lot of the evidence of my early experimentation in fintech content creation is no longer accessible to the general public.
Wait, so do you still agree with that? Do you think branches really are dying, or what is happening there?
Yeah, I think that's a good question. I think that branches, like digital and like call centers and like any other channel, ATMs, I think they have a purpose that works. And I think where banking has gotten itself into trouble is whenever you utilize one channel too much at the expense of using other ones. And so I do think for certain types of financial services companies, having an in-person retail presence can be a huge advantage. And, I always like to think about the sort of counterfactual, which is like, if I could just snap my fingers and give 10 of JP Morgan Chase's most valuable branches to SoFi, what would SoFi do with them? Would they, just say no thanks and give them back? Would they, build cafes? Would they build bars? Would they build different versions of branches? Would they build co-working spaces? I don't know, but I'm guessing SoFi would probably find a way to use those assets. It's just that SoFi historically has not really grown in that way. That hasn't been their model. So I kind of see branches always existing. I just think that they will play a much less important role, particularly for transactional type activities, than they have in the past.
Yeah, it's pretty interesting, right? Like, where will branches develop? It's one of those things where a large majority of Americans still loves just having that personal connection.
Yeah.
And I think we'll probably see a lot of that still with newer fintechs, with newer, even like the older financial institutions. How do we innovate on this model, right? Like Capital One cafes, and they're experimenting with that, right? And, is that really a great investment? What's the conversion rate of that? And I'm definitely curious to see how that will evolve within the next 10 years.
Yeah, no, I agree. I agree with that. I think that there's a difference in terms of the market that you serve, right? And so, like as another example, Fifth Third is adding a ton of branches right now, particularly in the sort of southeastern United States, and they're not a stupid company, right? And so if they're adding branches, they're getting something out of it. And my supposition would be that for wealthy customers, for commercial customers, for people who do benefit from a little bit more of that in-person hand-holding, building branches can be a very effective strategy. So I would never say branches are going to completely disappear, but at the same time, when I first wrote that blog post in 2008 or something, it was definitely true that we had too many branches and banks were too reliant on them relative to other channels. So it's all about finding that balance.
I agree. And we're going to be getting better data, better ways to collect data. And through that, they'll be like, okay, cool, it's totally worth it to invest in this or even change the way that we do branches, right? Super fascinating. But I kind of want to bring it back to, you started out at Zoot, you learned a lot of great stuff, and then you went to FICO.
Yes.
And I think I'd love to hear a little bit more about that. And I think really your exposure and how your exposure to that led you to kind of some of your focus on credit and lending, and really how has that shaped how you've kind of like written a lot of your content?
Yeah, FICO is fascinating, and I think that as you might imagine,
I love it.
It's one of those companies and brands and products that has universal sort of awareness in the market, right? Everyone knows what it is. The whole sort of industry kind of revolves around it to a degree, and I think it is really important. One of the pieces of like career advice I give to people who are sort of just getting into fintech is it's always really worth having a career stop at a big company like that, because you think you understand these things from the outside, and then getting to see it up close is just a very different experience. And you get to learn a lot about how these very large, complex, highly regulated systems actually work. And some of the things you learn are a little disturbing, or like, wow, I didn't realize this was duct taped together quite as much as it is, or, what have you. And, some things you walk away with a much greater appreciation for, I used to think this was kind of silly, but actually it turns out that this is really hard to do, or this is really important, or I didn't really understand this. So there were a lot of things about the way the credit system in the U.S. works, the way the credit bureaus work, the way the credit scoring works, that I kind of knew at a surface level, but when you work in real close proximity to it for a while, you just get a different appreciation for it. And, in terms of how it's like shaped my view overall on fintech and kind of what's happening, the biggest thing for me is once I sort of learned to see the world in terms of positive and negative selection, I sort of have been unable to view the world in any other way. And so, that applies very specifically to lending when you're talking about building a portfolio and, the customer acquisition techniques you use, and are you positively selecting for the customers you want, or are you negatively selecting for customers that are going to cause you a problem? But, if you look at just like the market generally and the world generally, it all runs on positive and negative selection. And so it did definitely kind of reprogram my brain in terms of thinking about just the world a little differently.
Gotcha. And just double tapping on the positive and negative selection, is that kind of one of your, when you want to help out a company, or you're advising or even investing in a company, do you kind of use that as a bar, as like, how are they really double tapping on positive and negative selection, and then how are they implementing this in their business model?
Yeah, I do. I mean, I think that a lot of times it's kind of like medicine, right? Like, we tend to really focus on the symptoms and trying to treat the symptoms, and we don't always necessarily try to get to the root cause of what's causing the symptoms. And I think it's a good example of when you look at a business, and you're like, oh, for example, you're trying to figure out, well, how much money should we spend on customer service? Should we just have sort of self-service chat? Should we have a call center? If so, how available should we make ourselves for call center inquiries? How much time should we try to spend on the phone with our customers? What type of cost is acceptable? You can treat that as just sort of an optimization problem that's right in front of you. Mm-hmm. But a lot of times that won't drive the result that you're looking for if you don't go backwards to the sort of upstream factors that might be causing customers to call your call center in the first place, right? And so a lot of it ultimately does end up, relating back to positive and negative selection, right? For example, are you somehow through your customer acquisition or onboarding process bringing on customers who are more likely to have a particular category of problem that's ending them up calling your customer service line? If so, optimizing your customer service functions won't necessarily fix that upstream problem, right? And so I think a lot of decisions that get made about how to build out a startup, how to build out a business, how to design your product end up getting made without enough appreciation for like what's driving the conditions we're trying to solve for.
Yeah, that makes a lot of sense. I think even in the world of early stage startups, probably bigger companies, you always have these metrics, right? And it's like, well, how often do you question those metrics and their validity in your actual your core thesis of what you're building, right? It's like, oh, we've reduced call time waiting, all this stuff, and our NPS, and it's like, well, what even goes into your NPS? Like, how are you even looking at that stuff? And I think it's something that, I mean, even what we're learning as well is like, how do you consistently question that in the right way? I don't know, I'm curious, have you found any good ways, like any good mental models for questioning that?
The thing I've always tried to sort of view the world in is when I was at a consulting company earlier in my career, we always used to have this debate about sort of type 1 and type 2 problems, right? And so, the first type of problem was, hey, we have way too much work that we need to do. And in consulting, like literally time is money, right? And so you have to be very careful about how you allocate your hours and how you're sort of monetizing your time, because that's the whole game. And then the second problem was, hey, we're not selling enough. We're not getting enough clients interested in our services. And it was really interesting to me because there would be parts of the business that would try to sort of optimize against a different metric that would treat those two things as the same problem, right? Like, hey, we just, we don't have enough time. We don't have enough capacity. We're not making enough money. And I always tried to sort of organize it more in the sense of what are good problems to have and what are bad problems to have. Because every business, you're a founder and CEO. You wake up every morning and you have 19,000 different problems to solve. And that's just the nature of certainly running a startup, but even like a mature business, like they don't run themselves. There's problems every single day. The challenge is distinguishing between good problems that you want to optimize, make better, remove some of the pain around, but ultimately, like, you don't want to screw with the conditions that created this problem at all, because that's what you're going for, right? Like in the case of consulting, we were really busy. We had way too much work. How are we going to balance all these things? Well, that's a good problem to have. So let's try to figure out the answer to it, but let's not do anything that's going to cause us to have less demand for our services. Whereas there are other problems where you actually have like a bad problem. Like this is something that's going to materially push your business in the wrong direction. It's something that you need to urgently solve for, and you need to get back to those root causes in order to address it. And so I always tried to sort of view the world in terms of good problems to have versus bad problems to have, and even specific metrics like, revenue is another good example, right? Is this revenue that we're making good revenue or bad revenue, right? And I was when I was at FICO, actually, that was always one of the things that we talked about was, okay, well, we can sell it this way, and this will have a really big upfront recognized revenue number because it's a little bit of transaction revenue, but it's a lot of like professional services and implementation and a lot of upfront one-time work. Makes it look really good on a quarterly earnings report, right? But I was always under the sort of impression, or I was always making the argument that like that's bad revenue. You don't want that revenue because you literally have to like use your time to get it. It doesn't just continue to kind of trickle in. And I was always much more a proponent of let's try to optimize everything we're doing to get as much good revenue as possible, which was that recurring revenue, passive. It's connected to an activity that's valuable for our clients that they'll never question us, charging them for. Like that's good revenue. And so even specific metrics like, revenue's up, it's worth interrogating that and going, is this good revenue or is this bad revenue?
I love that. I may take that from you.
Steal it. Yeah.
Really just focusing on that too, right? Is good revenue, bad revenue. How would you actually break that down? And something we kind of do as well is really, what is the ROI deliver? And how is this ROI like going to grow? Not just from a repeatable process perspective, but like, is there expansion revenue within that? I'm curious, do you account for that sort of stuff, and how do you think about that?
Yeah, to me, a lot of it comes back to optionality, right? And you always want to be creating as much optionality as you can with every single thing that you're doing, right? So, if you're, just to give another like example, if you have the ability when you're signing a contract with a client, and let's say you get to the end of the sales process and for whatever reason, they're sort of unhappy and they're not super, super unhappy, but they're not thrilled and maybe something changed with their business, or maybe sort of the commitment they made when they signed the contract is now something that they kind of regret or circumstances have changed a bit. You have a choice when that happens. And one option is to make them stick to the agreement, which they will do, and you can collect all the revenue that you thought you were going to get, and that there's certainly an argument for that. And sometimes as a business you need that revenue, and that's just the way it is. But I always think it's really important to value the future optionality that you're giving yourself by taking a different path. And in that particular case, the option value of being able to go back to a client and say, if this isn't a good fit, we can absolutely cancel this contract. You can come back to us when you're ready. Like, you create a lot more option value in the future by doing that and making a client really happy and giving them more flexibility. And, one thing I've definitely come away from working in the financial services space for so long is it's a weirdly small industry, right? And so you actually, the more you sort of think long term and think about the option value of the different choices you're making, the more you're sort of reinvesting in your reputation and sort of the value that you provide to the ecosystem. And I generally what I found is that stuff tends to come back to you and just gives you a lot more optionality and flexibility in the future. So where possible, I always try to find, those situations where, A, we're going to benefit from this in the short term, but B, this is going to create a lot of option value for us in the future. And those tend to be the more valuable choices in my experience.
Wow. I'm taking notes on that. I love the terms you're using, the option values. I don't know if that's an official thing, but it should be.
Yeah, it's literally just made up in my own brain, but it's, when you make those mistakes going the other way enough times, you sort of learn the hard way that, we should have gone the other route. And, personally for me, a lot of my career has benefited from, even like when you're making career choices, the optionality associated with whatever path you choose, right? So like when I went to be a credit card analyst for a few years, it was a good job and I was making more money than I had made before, probably could have made more money going elsewhere. But the thing I thought was really cool about that job was I didn't actually know that much about payments. And so at the time, it was a little bit like getting a master's degree in payments, except they were paying me to get it rather than me paying for it. And so, the ability to both have a good paying job, but also the option value of building knowledge in payments that I wouldn't have otherwise built, like that made that path slightly more exciting and interesting to me. And the more you sort of lean into optionality, the better things tend to go in my experience.
It's very interesting. Payments is very nuanced, by the way. It is very, very, very nuanced.
It is.
I spent a little time in there. That's funny. But, really, you're also an investor in a couple companies. You write a lot about different types of trends that are happening. What really excites you, or what are you really excited about, and what are you attracted to, not only with, the Knot or Teddy that you've been a part of, but other companies as well that are popping up?
Yeah, no, I mean, great question. I think that some of the things I'm really curious about are, I'm always been kind of an infrastructure guy in my heart of hearts. I don't come from a direct B2C background, and so I have a tremendous amount of respect for people who can go into a B2C environment and can spin up a really efficient marketing and customer acquisition engine and can kind of play that arbitrage game. Like, I have a tremendous amount of respect for that skill set, but I don't intuitively understand it or know how to value it. Infrastructure, though, I do understand, and I know how to value it and think about it. And I think that we are still taking for granted just how much old infrastructure the financial services ecosystem runs on. And the easy example of that is how many lines of COBOL code there still are running around in financial services, and it's hundreds of millions, it's billions of lines of COBOL code. That's kind of the easy surface level example. But even if you sort of double and triple click down, everything that happens in financial services runs on some kind of system that was probably created in 1994. And there are opportunities to add value in every one of those little niche infrastructure areas. And the reason that fintech hasn't penetrated a lot of those areas historically is that that's not the low-hanging fruit. The low-hanging fruit is, hey, can we build a digital bank that can compete with OneMain Financial or Wells Fargo or whatever? That's a pretty obvious opportunity, and that's obviously what the first sort of wave of fintech in the mid-2010s really went after. But to me, the more interesting stuff is, what's the infrastructure, what's the system, what's the piece of technology that the entire industry sort of hinges on, but only 12 people in the industry know what the name of the system even is. You know what I mean? And when I uncovered those things in fintech and I see fintech founders building in those areas, that's where I get really, really excited, because, I'll be like, wow, I've never heard of that. They're like, yeah, actually 70% of this market runs through that software. And you're like, really? And they're like, yeah. And you're like, well, how is it that no one knows? And they're like, well, it's to the benefit of everyone in that space to not know about it, right? So one that's become more prominent recently, but for years and years was totally under the radar, was the Work Number solution by Equifax. And so it's this income verification product that Equifax had, and mortgage lenders would pay Equifax $60 a pull to get verified income for a mortgage application. And Equifax owned 90% of that market. They were the dominant provider in that space, and they were just quietly collecting massive checks. In fact, Workforce Solutions became the number one business under Equifax. So we think of Equifax as a consumer credit bureau, and your credit fund, your credit score. It's actually not. It's a workforce solutions business that sells verified income and employment data. That's where they make all their money. And for years, they were just hoping that basically no one would notice because they had no competition in that space. And then all of a sudden, people started noticing, and a lot of the work that's been done in the payroll API space is directly aimed at getting enough payroll data to disrupt Equifax's hold on that market and compete in income verification for mortgage applications.
Wow, I did not know it was that expensive. And to give a couple examples, are they the payroll, like Pinwheel, or what are a couple other
Yeah. So Pinwheel, Argyle, Atomic.
Is Finch in that? That's more like HR kind of
Yeah,
stuff.
I think they're a little bit more HR. But yeah, I mean, like Payroll API, it's like opened up this entirely new world. And it's a really good example of if Equifax had the ability to get programmatic access to people's payrolls accounts at the time they built that business, they probably would have built it that way. It's just the technology didn't exist at the time. And so to me, that's the thing that's really exciting is we assume these systems just work the way they do and there's no way to disrupt them, but like technology always goes up and to the right? We talk about large language models, right? Like there's all of these technologies that can do fundamentally different things than we've ever been able to do before. And so the really exciting part is let's map all these new technology capabilities onto old established problems and find opportunities where the technology can help us do it 10x, 50x, 100x better, faster, cheaper, more intelligently. And I mean, you can make just a tremendous amount of money and create a ton of value by just going after those areas. You don't have to invent some brand new, product that's never existed before. You just have to understand the products that are already out there that the system rests on. So to me, that's where I get really excited.
I 100% agree. One kind of metaphor I like to say is, in the 1500s, 1600s, the backhoe or the ox plow was invented, right? Yeah. And it like revolutionized farming. It was like I saved 10 hours a day doing this. It was manual before, and I like that. As rudimentary as that is, I like to think about software and new processes like that. Like, cool. How do we think about whatever we build? Just like correlate that to something like a simple thing like the ox pulled plow, right?
Well, and I think the thing about that's really cool is that you shouldn't just think of saving someone time as a function of, I saved this person some time, which means they can not spend that time, which means they're saving some money, or maybe they don't need to have quite as many FTE on staff to be able to do this thing. That's the easy way to conceptualize the opportunity is just time saved. But I think the more important way to think about it is, what is a market that is not viable today because it's too expensive, but can be viable tomorrow if we make the costs a tenth or a hundredth as much as they are today? And, there's just tons of opportunities in financial services, like, small business lending is a really easy example. Small businesses need capital, and banks want to give it to them, but it's historically just been way too expensive to underwrite small businesses for loans. And so that's why there's not nearly as much small business lending happening as there should be or as there's a demand for. It's just a cost problem. And so if you can use technology to knock out big chunks of cost from that process, you are not only saving people time and money, you're actually opening up an entire market that doesn't really exist today.
Yep. I 100% agree. Think of steam engines, the Industrial Revolution, anything like that. All these new types of ways of doing business, right? Anheuser-Busch actually started as they had a patent on refrigerated transport on trains. They had a patent on that.
Yeah.
And that was like their main business driver, but really like that was a unique innovation that happened. I know I wish this could go on longer. We're actually coming up on time. Alex, we could have talked probably for 30 more minutes. This was incredible. I got some really good juicy nuggets for myself. Hopefully everyone enjoyed it as well. But something we like to do here, we love closed loop systems, right? No KYC, none of that stuff. So as a gift, I'm going to gift you a gift card to Applebee's.
Well, I appreciate that. It was that was the cool restaurant back in the day in Bozeman, Montana. So I do appreciate that. That's awesome.
Yeah. Well, Alex, I hope you have a great rest of the weekend and really great having you on.
Thanks for having me.
All right. Bye.